Mode.
Hey everybody, Preston Bryn here with our weekly roundup. This is for the trading week ending January 2017. Thanks for tuning in. Hey, what I've got on the screen here is the 2-hour chart of the E-mini S&P 500 futures. And as you can see here, there's a lot of activity on this screen. But let me just clean it up for you just a little bit here so that we can just kind of focus in on a couple of things. Number one, the markets after the presidential election quickly moved up about 8 percentage points or so and then settled into a very tight range. And then since then maybe eked out another 2 or 3%, so roughly around 12% off the lows from the presidential election. And by the way, this time frame here, and let me just kind of box it in for you again here. Right in this area here is right at about December 7th, December 8th, 9th time frame. So it's about 4 weeks post-presidential election here in the U.S. And since then, we've just been on a road to nowhere. We've traded in a wider range here of about 50 points or so on the E-mini, but that's just kind of where we've been sitting. Now, the thing that I want to point out is that we're kind of in a show me kind of market, or as they said in the movie Eddie Maguire, or I forgot the name of it, but you know, show me the money kind of thing. That's kind of where we're sitting right now. Show me the money. Show me what happens. We've got Trump coming in. We've got a number of things that are going on in the market right now. I mean, if we look at 2017, what we have coming up, I mean, we have potential capital depreciation or capital flow from China. We got a lot of political issues going on over in Europe right now. A lot of political votes, populism rising with the Brexit move, and we're going to see that coming to fruition in 2017. We got Italy, Germany, the Netherlands. We got all these key votes where populism is taking over in those countries, and France. Going very strong in the populist movement area. Every one of these countries, or at least some of them, are talking about leaving the euro if the populace in that particular country wins. That would do tremendous damage to the euro, upset the markets. We've got a very strong U.S. dollar as we go into the beginning of 2017. We've got gold starting to rise now, coming up off the lows that it had through 2016. U.S. bonds have been in a pretty good strong fall since the summer. We've got the Feds talking about a 3 rate hike environment. Their dot plot indicates 3 rate hikes. The markets have priced in, I believe, 2. And not to mention, we've got a new administration here with Trump and all the things that the Trump administration says they want to do. And besides all of that, we're right in the middle of, or just kicking off, Q4 corporate earnings. You know, we've had about just slightly under 50 companies report already. And, you know, according to the data, about 72% of them have surpassed their forecast, which is better than the 65% average that we've seen. Now, you guys know we've been in an corporate earnings recession here in the U.S. for 5 quarters in a row, and we just kind of broke out of it in Q3 of 2016. So now we're going through Q4 earnings. It looks like it's going to continue to grow, and the forecast for 2017, a lot of it rides on some of the policies that Trump is going to do. And then throw all of this into the pie, and we got very low volatility as we go into 2017. Okay, so this is why we've been in this very tight range here. This is a day trader's market where you can get in and scalp some points, but longer term, trends are quickly reversing and then reversing again. It's just, the market is just waiting to see how things start to unfold. I do believe we're going to break this range here. I think 2017 is going to be a year that focuses more on corporate earnings, which kind of gives a tipping hat to the stock pickers of the world, from the previous years where it was mostly just easy monetary policy and the Fed supported the the movement here. And if you guys understand, we've been in at the start of 2016, earnings were projected to grow about 6.5% for 2016. But at the end of the year, corporate earnings were essentially flat, but the markets were up 10%. There is a lot of hope out there right now, optimism out there right now, and more bullishness among small and medium-sized companies. So there's a lot of this pent-up demand that, will it come to fruition? Well, I really don't want to be in the guessing game on that. All we need to know is we're going to follow the price action and do what the price action dictates to us. If I come in here and let's just back it out just a little bit here, you can see in this area right here, let me just kind of move it out a little bit here. You can see right here the December or the November election right there. We actually moved below zero for the year in the E-minis. We were at 2028, lock limit down. And then from there, the next day we actually opened up and then we just started moving up. And then we kind of hit a wall right in this area right here, anywhere from 2240 to the highs around 2277. I mean, we just hit that wall, and then that's just kind of where we've been since. And so for this run right here, it's roughly about 4 weeks, and that's kind of where we made the bones for 2016. That was where the markets made their profits for the year in the last 4 weeks of the year, or just 4 weeks, and then since then we just been in this very tight range here. So again, it's a show me the money or a show me kind of market, and we're just kind of sitting on everything until we can see how this thing plays itself out. So that's a little bit about what is going on right now in the marketplace on the E-mini S&P 500 futures. You can see on this daily chart here, again, this volume over price, how there's just a lot of volume right in this area here. And then there's support right down in this area here, right around the 2200 level. Should it start to weaken, that would be a very strong support point. And then you can see there's a lot of volume back down here around 2134. Now 2134, the reason why that number is significant is that was the all-time highs of the market in 2015, and then we pull back, and we set a record in number of trading days trying to take out that all-time high. It was 400 plus days, so it's a significant number. And then we got 2200, and then of course where we're sitting right now. So these are going to be some key numbers I'm going to be looking at as we move forward in time. If I put it on a daily chart here, and we just kind of ease back a little, you can see that there have been instances where the markets have moved up and then have been in a very tight range for a longer period of time. And then it gave it up, and then now we're sitting here like this. So don't believe that we can't be in this for a long time, because we can't. We can be at this for quite some time. Right here, we were in this actually from the beginning of 2015 all the way through the summer of 2015. I mean, we just kind of sat right in the middle there, and then right around August, that big down move there was the Chinese devalue and the yuan. It got things going, and then it got very choppy until we reversed course again back in October, coming through the end of the year, right? And then we got right back up into where we were before. Right? If I were to extend that out just to show you the difficulty the markets will have, and let me just extend out that range right there. That's the range. That is where the markets seem to like trading. Generally right off of the 2028 area, right? All the way up to around the 2125 area. Markets, and you can see the volume here on this daily chart, just a lot of volume that's going to provide support. This is volume over price over here. But a lot of volume in this area, and granted, we have these big moves to the downside, and then we have these extensions to the upside, and now we're sitting in this tight box right here like this, okay, off of this move. Even when we extended the first time in summer of last year, we came right back down into this box. and this kind of floated here for a while before we took off again. So I do believe we're going to revisit this area. I can't say what kind of event is going to get us back down here into this box again. We may even break this box. If we do, then the challenge is going to be down in this area here that we hit in February of 2016 to kick that year off, because this is how we kicked off 2016 with these big moves down, and then we quickly got back up into the trading range again. We stayed here. We did break out, but we came right back down here again without a final breakout, and then with the Trump election, it moved us from this trading range that the market seemed to have liked for the past several years back up into this area here. Now, what's going to drive the market higher? The only thing that's really going to move this market higher is not going to be the Feds. Remember, the Feds are pulling money out of the market, trying to get that balance sheet down. It's going to be corporate earnings. It's going to be earnings per share. And a focus on PE ratios and valuations. So that's why I say it's going to be a valuation market or a stock picker's market, and we need to see good corporate earnings. Now, we've started this one off nicely and people are paying attention. What I'm seeing so far in those 10 or 12% of the companies that have already reported out of the S&P 500, I'm seeing those that hit move up a little bit, not a lot, but a little bit, kind of within the defined range that the market, option market, is priced in. But those that miss, they take a dive, they take a header. So companies, they're going to be punished if their forward projections and they have a miss. Now, we've had banks come out and report already. What's really interesting that I look at in the bank stocks, right? Let's just put in XLF right here. If we look at XLF, which is the banking sector, you're going to see here, it's actually showing some weakness here, right? Now, and I've just got this on the screen here. You can see as we go through, this is obviously the bank sector was one of the best sectors post-Trump election, right? The Trump election was right in that area there, and then post-Trump election on the stimulus that he's looking at doing with tax cuts and so forth, it's just, you know, boom, we came up here literally these 4 weeks roughly right in this area here, and then we just settled in, and then we've just done this gradual slide down like that. So that would kind of be the pattern there. That would suggest a breakout to the upside. Now, the bank stocks that have reported, we've seen the financial sector, we've had, you know, basically more of them beating than not, right? But we're just seeing some profit taking here, that's all. If we do get higher interest rates, that's going to be good for the banking sector. So, but pay attention to this. The other thing that we've seen that's done very well is in the oil sector. So if we look at XLE, you can see here on this daily chart, coming in from the November time frame. Again, I'm just moving a little bit larger here. You can see from that election here, just like the financial sector, we came up and then boom, it was just a rocket ship up, and now we're just having this downward draft like this. I suspect it's probably not going to go much lower than roughly the 72 area. I think the 50 EMA should hold up. That's what it looks like it's doing or supporting. So that's kind of where I see the financial or the energy sector at the moment. Now, if we come back to the markets and if we look at the Russell, you can see here on the Russell, same thing. It was below the 2016 open price here on the election night, and then boom, it just shot right back up again. And then it made its high actually in 2016 on the 12th of December. And then it's just slowly been moving lower, right? You can see right here, the 2017 low was actually made in the Russell on the 19th of December, right? And here's the 2017 open price. So if we just blow it up, let me just widen the chart so you guys can see it a little bit better. You can see right here where we're sitting in this range. I don't see this drop here as anything to be worried about at this point in time. Remember, a lot of my buddies and folks that I work with and some in hedge funds have been basically bearish or going more to cash, and they've missed out on a lot of this run. Hell, everybody missed the call after the Trump election. We hung out there with a couple of long futures contracts in the Dow at 17,750. We had some buy orders out there in the Dow for 17,750, and that was when the Dow was at about 16,550 or even lower on the night of the Trump election. And I put those orders out there because I said if they trip, it's going to run. And sure enough, they tripped and the Dow ran like crazy. So that was not me knowing what was going to happen. It was just if it does break, it's going to run. And that's what it's done. Now we're sitting here with the Russell. Now, if you look at the, let me come back a minute just for the E-minis. And I'm going to put everything back on the screen here so that you can see this on the daily chart. You can see with the E-minis, we actually hit the high here back on January the 6th. Remember, with the Russell, we hit the high in December, the second week in December, right? Here's the Dow, or the E-minis. If we look at NASDAQ, because NASDAQ has just been doing, it has been doing very well. The NASDAQ actually made a high on Friday, right here. It made new highs and then backed off. So we're still moving strong in NASDAQ. You can see the dot-com bubble high of 48.84. Right near this green dash line right here. So we're still on a tear, and there is no divergences here at all. So that suggests the NASDAQ can still be stronger. So technology is kind of coming back into favor again. I like Google this year. Yeah, everybody likes Amazon and possibly Facebook, but I'm kind of a Google guy. I think Google could do really well. That's something that I really want to watch and see how that thing comes through and plays itself out. But I do like Google for this year. In fact, let's just look at it here for a second here. And if we pull it up on the screen, you can see here on this daily chart, we're coming up to a high right here like this, but I think it's got more room to run. I think it's going to be trapped in a little window here, but if we can take out this 839, it's going to run up to 850, 875 fairly quickly. So that would be kind of how I see Google. Okay. Now, if we go back, and one thing I did point out is volatility is very unusually low. Well, before we look at that, one other thing, I do want to show you the Dow Cash Index. It has been sitting here. We did not make the 20,000 number, and even though it really in the scheme of things means nothing, it's a nice interesting round number, and I think we're going to take that out, that all-time high out. That's a headline number, and that headline number basically means that as soon as it hits, then the Rat Brain Business Journal of the day, the National Enquirer, is going to say Dow hits all-time highs. That'll draw in more rat brain traders into the market, basically neophytes. And we got to be careful in some of these numbers here. But you can see this huge run. And actually the Dow started the run, unlike the other indexes, started the run before the election. And then on election night here, it took off. And then it's never really looked back since. And now we're just in this consolidation mode, which again does not surprise me. We can see the MACD down here on the 0 line, probably going to find some support right in this area right here, probably do one of these numbers like that. If we do move up in this area, it'll probably set us up for a little bit of a divergence here, which would suggest another retest of this area again. But it's all going to be about earnings. And then we got these geopolitical events in Europe, as I said. We got these issues in China that can come up, and then lay on top of that the Trump administration. And if he can get half of what he said done, you're going to see another 5% bump to the upside in the U.S. indexes. Okay, and because it's just been so long since they've had tax reform, reduce regulation, and things of that nature. So it'll be very interesting to play this thing out. And look at the VIX. The VIX is very low. I mean, the volatility here, to enter a year with volatility this low is amazing to me. We're in this green zone here. Notice I've got my VIX on my chart here colored in different zones. Green, yellow, kind of a, I don't know if that's pink, and then red, and then black. Black would be black swan events. Generally, you can see what I've defined these as. Okay, VIX, the longer term average of VIX should be around 17 or 18. We're sitting here right now with a VIX that closed on Friday at 1154. Folks, that's low. All right, that's very, very low. And when we do know from history that when VIX gets this low, it can stay low for a while, but it's subject to these violent extreme moves to the upside. So I think long volatility plays make some sense. This Sunday night, our members and those that are members of our secret trader group, we've already started the year very successfully. We've closed one trade down, made some nice money in that, and we got other trades that are pretty much all profitable right now. So we're going to continue with that. If you're not in our secret trader, check it out, because I think it's very inexpensive, and it's worth it to follow along, at least from an educational perspective. So that's volatility. The other thing that's really amazed me is the bond market. We've had the bond market start that rollover. Now, I had put this out there for our members. I said the bond market looks like we're going into this 3, 4, 5 pattern. And that seems to be exactly what it wants to do. This is a typical Elliott wave pattern, and the 5 leg is projected to be somewhere down in that area right there. Split the difference, call it 145, right? It's $1,000 a point. For the bond futures market, right? So we're sitting at 150, so 145, so call it about 4,500, maybe $5,000 if we go from here to this level down here in the bond market. I do think that the bonds are starting to settle in now. We've had this huge move to the downside. We're still in this downward trek. Any upward tick like this should be sold. And you can see here in the bond market, this red line is the 50-day moving average, and you can see here we just could not get over it. You could see the same thing right there on the 200 EMA. Once we broke the 50, we could not get over it. And then we had finally the 200 breaking the 50, or the 50 breaking the 200 to the downside. So we've just got a huge amount of downward force on the bond market. And if the Feds hike the rates 3 times this year, we start to see a whiff of inflation, and the euro it's just going to weaken the euro and other currencies. The dollar's going to get stronger. So Trump's not going to get his wish. And we're going to have a lot of conflicting things going on in the U.S. market with a stronger dollar. And, you know, what's that going to do to corporate earnings? Is it going to put a shield on it? And then there's going to be a competition for capital, because the richer the bond market becomes, interest rate wise, yield rise, is going to start competing with equities for cash. And up until now, it's relatively low. It's still very low historically. But the higher it goes, the more it's going to be competing with cash. Or equities rather, for money inflows. So we're going to have a lot of really interesting things to look at for 2017. And then of course, if we look at the dollar, all eyes are going to be on the dollar this year, because the dollar is just about everybody and their uncle is saying the dollar can go higher. I am going to take an approach that says the dollar's not going to go as high as people think it's going to go. Okay, I think we may get a little bit of a bounce back to the upside in the U.S. dollar. Down here, it may be worth looking at, but I just don't see the dollar going too much up from here. Maybe a little bit, maybe taking out these highs here, but we've been on a tear with the U.S. dollar for a while here. You can see once we hit these lows back in summer of 2016, it's moving back up here. So that's kind of where I see the dollar right now. It's more subject to upside move than downside. It's a little bit of a profit taking right in this area here. A lot of it's going to depend on the Feds and what Trump's doing. So let's just kind of see how this thing plays itself out. The other one that I really like in 2017 is the pound. I think the pound is set for some action based on how Theresa May creates this exit move out of the European Union, and I think that the pound, you know, can go a little bit lower, but I think it's got more upside to it than downside. And then the euro is going to be strictly tied to the ECB and what they're doing. You can see here the euro is moving up, coincident with the US dollar moving down. So I think here this could see one final downward move here. I had projected the euro to come down here to around 102 to the dollar. I'm not sure. I don't know if we're going to get there, but that was my original projection. I mean, we're close. We're at 106. It was down to 103.6, and it actually hit that low back in December, and then also again back in January. We had a double move here. We got a bullish signal to go long here back around the 23rd of December. I did not take the long position. I was flat at the end of the year, but that's kind of where we're sitting right now on the dollar. Then, of course, if we look at gold, I think I have said this many times before. I said gold is going to finish 2017 higher than where it starts. And you can see we actually started the year around 1158. We're up already. I think gold could possibly have one further move to the downside, but I'm going to be playing gold mostly in and out to the long side in 2017. Silver is going to be pretty much the same. You're going to see a little bit of this movement here in silver, possibly a little bit to the sideways to the upward position, upside. One that we didn't play last year that I think can be bullish this year is copper. You can see where copper is sitting now. We had a huge run up after the elections on the potential infrastructure build out that Trump wants to spend. So things like U.S. Steel, or copper, Freeport-McMoran, JJC, anything that tracks any of this could have a bullish year in 2017. So we're going to be looking at these. And then, of course, if we look at the energy market and oil, you can see here oil. I don't think there's going to be a lot of upside in the oil market. Remember, in another week or two, we're going to get the initial report on how look how good we're doing, OPEC and non-OPEC, and adhering to our production cuts. But I think that's going to be a failed policy by the end of the quarter. I think we're going to find cheaters, and once one cheats, they all cheat, and then you're going to see oil give up, probably anywhere from 5 to 10% of the current price, which puts us back down in the low 50s or into the high 40s or mid 40s. So that's a little bit about where we're seeing with the energy market there. And then natural gas. We're coming into the seasonally weak period of nat gas, so I could see this going a little bit lower here over the next month or so. And then finally with gasoline. Gasoline, although it's not correlated perfectly with oil, it's close. I think gasoline is going to settle in here as well. So that's kind of where we're seeing these markets. We also entered some trades in the agricultural market this Friday. And we've also done some things in the meat market. We haven't done anything this year. And then in the soft market, as you guys know, we've been short orange juice in the futures market. This has turned out to be a great trade for us. This is like our third entry into orange juice short. Every one of them been successful for us. And we also did a short play in sugar. You can see this huge move in sugar that we had the other day. We got in, the timing was really good. I see sugar moving down here a little bit lower on this trade here because sugar got, I think, ahead of itself. I think sugar could move a little bit lower if I just kind of project it out. It's saying sugar could come down to around 15. It's up to 20 right now. So I think there's some more downside action that we can see in sugar. Okay, so these are just some of the ones that we're currently playing as well. Again, our members and our secret trader members as well, I will see you this Sunday night for our session. We'll look at the upcoming week. We'll look at the trades that we got currently going on and some of the things that I'm looking at new. Also, if you're not a secret trader member, I highly encourage you to come in, check us out. It'll be worth your while. If not anything, but from an educational perspective. But we're having a lot of fun kicking off the year the right way, just like we finished 2016. Or even better yet, come on in and look at our membership group. Our user group is growing very well. We're more an international group than just local. That way we can play the commodities and play various markets. It's a lot of fun. All right, everybody, have a really great weekend, and members, I will see you Sunday night. Take care, everybody. Ciao.